Companies like Tesla and MicroStrategy now hold large quantities of the asset in corporate reserves. Over the last few years, firms like BlackRock and Fidelity have begun allocating billions to Bitcoin. Companies like Tesla and MicroStrategy now hold large quantities of the asset in corporate reserves. This institutional adoption has led many financial analysts to describe the digital asset as digital gold. Traditionally, gold has served as the ultimate safe haven. It is a physical, 5,000-year-old element that central banks and private investors rely on to preserve wealth when traditional markets or currencies fail. Bitcoin, by comparison, is a 15-year-old string of computer code. It is completely invisible and exists only as entries on a decentralized ledger. Much of its early history is defined by extreme price swings and its role as the primary currency for the illicit dark web drug trade. To see why economists now take the comparison to precious metals seriously, we have to look past the cultural reputation and examine how the network's code was engineered. In 2008, a pseudonymous creator named Satoshi Nakamoto published the Bitcoin white paper. The goal was to build a version of electronic cash that could be sent directly between parties without going through a financial institution. Nakamoto had to solve a specific technical problem: double spending. In a digital world, a file can be easily copied. Nakamoto needed a way to prove that a digital coin hadn't already been spent elsewhere. The solution was proof of work. Transactions are broadcast to independent computers, or nodes, which verify a single chronological history. To secure the network, miners use hardware to solve difficult mathematical puzzles, expending massive amounts of computational energy to validate the next block. This intentional computational friction replicates the physical resistance and the high cost of extracting gold from the earth. This production difficulty is paired with a strict supply cap. The protocol is hard-coded to ensure that there will only ever exist 21 million bitcoins. By combining immense production effort with an absolute limit on supply, the system creates a form of scarcity that gives the asset its long-term value proposition. If the scarcity is so precisely engineered, why does Bitcoin's price fluctuate so much more violently than the price of physical gold? Early on, Bitcoin existed entirely outside the traditional financial system, operating with virtually no regulation or institutional infrastructure. In 2010, one of the first real-world transactions involved 10,000 Bitcoins being traded for 2 pizzas, a moment that highlighted how little assigned value the asset had at the time. Its untraceable nature soon made it the currency of choice for the Silk Road, an online marketplace that facilitated millions of dollars in illicit, underground transactions beyond the reach of law enforcement. In 2011, the largest exchange at the time, Mt. Gox, was hacked. The security breach and subsequent collapse saw the price of Bitcoin drop from over $17 to just 1 cent in a matter of minutes. Despite these setbacks, the digital nature of the asset provides advantages that gold cannot match. A single Bitcoin is divisible into 100 million units called Satoshis, making it practical for transactions of any size. While moving large quantities of gold requires heavy logistics, secure vaults, and expensive insurance, Bitcoin can be transferred globally and near instantly in a single peer-to-peer transaction. Currently, these technical advantages are often secondary to market volatility, as speculative bubbles continue to form within a fractured global regulatory landscape. This text from a study by Zwick and Syed highlights a change in market behavior beginning in late 2017. Data shows that during periods of financial turmoil, the correlation between the price of Bitcoin and the price of gold began to turn positive, with the two assets moving in parallel. Institutional investors have begun using the asset as a deliberate hedge against the inflation of traditional currencies. Bitcoin has not yet achieved the status of digital gold. It lacks the centuries of stability and the global regulatory consistency that give physical gold its status as a universal safe haven. However, the network has demonstrated that a decentralized protocol can successfully maintain and enforce scarcity without the need for a central authority.